So let's get to today's feature segment, and that's Haag Sherman, CEO of Tectonic Advisors. Obviously, we've seen oil below $20, and this is monumental. And now you're saying you wouldn't be surprised to see it fall further, even down to $10. Haag?
Yeah, it's amazing, the fall in oil and gas. If you look at the demand destruction, we're looking at over 30% demand destruction. So in inflation-adjusted terms, oil today is about the same as it was in 1946 when it traded at $1.60 a barrel. And storage will fill up by May, so there will be continued pressure on prices before you see a rebound in the second half of the year.
Right. So what you're seeing now, how quickly do you expect that to happen? Right now it's at $25 and change, looking at light sweet crude. And how quickly do you expect this drop off to happen? Because we know that demand obviously has fallen off exponentially, as you said. Your thoughts?
Well, my thoughts are, if you look at the curve's in steep contango, which means the futures prices are much higher than the spot prices. So the second half of the year, you're looking at over $30 a barrel oil. So what the market's telling you is there will be a sharp recovery, sharp meaning from lows today at $18 or even maybe lower as storage fills up, to $30 a barrel in the second half of the year. So there is an expected recovery, but still at $30 a barrel, most of our shale producers can't make money. So again, there will be extreme pressure on the energy space in the US.
But you like Exxon. You like Exxon. So tell us when you think is a good time to get in there.
Well, Exxon obviously is a stalwart. They've been very disciplined about maintaining their dividend. And right now at $42 a share, you have an 8% dividend yield. So I would be looking to add Exxon over the next 2 to 3 weeks as storage continues to fill. There'll be continued negative sentiment on the space. If you can pick up Exxon in the upper 30s, mid to upper 30s, it's a buy, even if they cut the dividend.
Right. Right now it's at $42. So you're looking mid to upper 30s. Do you think it'll get there with the volatility that we're expecting, I guess, with each economic report or each COVID-19 headline? I don't know.
No, that's exactly right. I think you just hang around the hoops, to use a basketball term. Watch this one, and if it dips down into the mid to upper 30s, I think you pick it up and forget about it, because in a year or two, this one will absolutely have nice price appreciation, and at an 8% dividend yield, you get paid to wait.
Tell me about Bud, Anheuser-Busch. That's on your list of stocks you like.
Again, a consumer staple, a stalwart. 1 in 3 beers drank on the planet is Budweiser, or a Bud product. So again, you have, even with a 50% reduction in their dividend to basically help shore up their balance sheet, you're getting paid to wait at 4%. So low rates, consumer staple, even with modest to low growth, it's one that you put in your portfolio, and I think you'll absolutely be rewarded over time.
And last but not least, you also had another one on there that we were looking at, and that's China Mobile. You know, it's a name that I used to watch. I haven't looked at it closely lately, but you think there's some reasonable growth opportunity here, huh?
Again, they have less debt on a relative basis than Bud does, and China's reopening. China's economy is getting back on its feet. So instead of buying AT&T here, let's buy something in China with a reasonable debt level, a high dividend payout ratio, and some modest growth. Again, something that you put in your portfolio, you get paid to wait, and there will be price recovery on this company.
Yeah. So, I mean, I think you expect the volatility. You mentioned that you think risk is to the downside. Where do you think we'll be in 6 months, 12 months, 18 months? For the market overall, for the folks that have their money invested and they may be a little nervous right now?
Well, I think everybody's nervous. Unless you own Netflix, Amazon, or some of the consumer staples like Campbell's or General Mills, your portfolios have been battered. They've recovered some, but I think the earnings announcements that are going to come out over the next quarter or two are going to be dismal. Banks are going to be taking reserves against their earnings, so bank earnings will be dismal. They're not going to be out in the credit markets lending except under the SBA program. And so there won't be a great extension of credit. So it's going to take a little time before people start seeing a recovery. And I think that's going to weigh on the markets. But 12 months from now, 18 months from now, I think we see a rapid recovery, but I think it's going to take some time.
I see a rapid recovery, but we got to wait for it. Haag Sherman, great to see you. Thank you.